Hi everyone. Hi Professor. I'm Stina Saver. So this is my PPT and I will share the link of this recording in the first page itself. And let's move on to the presentation. Mm, Okay, so the first is the introduction. So let's talk about why valuation and understanding the time value of money are so important for the investors. So when we talk about the bond valuation, we are essentially trying to figure out how much a bond is worth in today's terms. And this is very crucial because bonds are a significant part of the fixed income market and it play a vital role in investment portfolios. So, why is it essential to understand bond pricing and interest rate sensitivity? Well, think of this way, bond prices can be influenced by various factors like changes in the interest rates, economic conditions, and etc. So, as investors, we need to grasp how these factors affect bond prices to make smart investment choices by understanding the bond valuation and interest rate sensitivity. So, we can better assess the risk and the potential rewards associated with the bond investments. And next is the bond A versus bond B. So in this slide, we can compare the two bonds, that is A and B. So they both have the same credit rating per value and couple rate. So however, there is one key difference, their maturity. And when we talk about the bond A, it has maturity period of 30 years, while bond B has a maturity period of 5 years. So now, why is maturity important in bond valuation? So, well, maturity simply refers to how long it takes for the bond issuer to repay the bondholder the principal amount. So, in bond pricing, maturity plays a significant role. So, typically, bonds with longer maturities tend to have higher prices than those with the shorter maturities. So, this is because investors demand higher compensation for investing their money for a longer period of time. So it's likely that bond A, with its longer maturity of 30 years, will trade at a higher price in the market compared to the bond B. And bond pricing in the market. So which uh, so which bond do you think that will trade at a higher price in the market? So it's, as we discussed in the last slide, it's actually bond A. Why? So, well, because the bond A has a longer maturity period compared to the bond B. So this means that investors who hold bond A will receive coupon payments for a longer time, leading to a higher total return over the bond's lifetime. Moreover, the longer maturity of bond A will also provide investors with more protection against the changes in the interest rates. So you see, longer term bonds like the bond A are less sensitive to the interest rate fluctuations compared to the shorter term bonds like the bond B. So to sum it up, when it comes to the bond pricing in the market, the bond with longer maturity tends to have a higher price. That's why bond A is expected to trade at a higher price than bond B. This is all about this slide. And next is the impact of interest rate changes. So in this, now let's talk about what happens if interest rates in the economy go up. So when that occurs, both bond A and bond B will see a decrease in their market prices. It's like seesaw effect. So when the interest rates rise, the bond prices fall. So here's why. As interest rate increases, the present value of future cash flow from the bonds decreases. So this leads to a drop in bond prices. So both bond A and bond B will be affected. So to give you a clear picture, let's consider an example where interest rates go up by, let's say, 1%. So in such scenarios, both bonds A and B will experience a decrease in their market prices. However, because like the bond B has a shorter maturity, its prices may drop by a relatively larger percentage compared to the bond B. And this is the impact. And let's move on to the percentage price change. So in this, now let's discuss which bond would see a higher percentage price change if interest rates were to go up. So of course it would be a bond B, like we discussed before. Let's move on to why. So in this, bond B has a shorter maturity than bond A that we talked before. So which makes it more sensitive to changes in the interest rates. So I will explain it in this way. Like think of a duration as a measure of how sensitive a bond is to interest rate changes. So the shorter the duration, the more reactive the bond is to the interest rate movements. So if the interest rates were to increase to say 1%, bond B would experience a large percentage decrease in its price compared to the bond B. I mean, compared to the bond A. So this is because of its shorter duration, which makes it more vulnerable to the interest rate fluctuations. And this is the numerical examples. That is now, okay, now let's dive into some numerical examples to see how changes in the interest rates affect the market prices of bond A and bond B. So we'll consider two scenarios. One where the interest rate increases by 1%, and the other where they decrease by 1%. So we will calculate the market price of both bonds for each scenario using their respective maturities and the given interest rate. So given interest rate changes. So by comparing the results bond prices, we will get the insights into how bond A and bond B respond differently to the changes in the interest rates. And investment strategy in economic slowdown. So in this, uh, for bond investors anticipating an economic slowdown over the next 12 months, so it's very crucial to adjust their investment strategy accordingly. So let's consider shorter term bonds. So if they're investing in a shorter term bonds or high quality bonds to minimize the exposure to the interest rate risk, and the diversity of the bond portfolio is to spread risk and mitigate the potential losses during the economic uncertainties. And if it's essential to align your investment strategy with the prevailing economic conditions to optimize returns and safeguard your investment portfolio. That is all about the investment strategy in economic slowdown. And let's sum up everything. So the main key points are, so we covered almost all the portion and we explored the critical concepts of the bond validation and the time value of money, which is the main topic of this presentation, which are the fundamental to making the sound investment decisions in the fixed income market. And also we discussed more about the significance of the maturity in bond pricing with the bond examples that we mentioned before, which is bond A and bond B, and the impact of the interest rate changes on the bond prices and the strategy for navigating the economic slowdowns of the bond investors. And uh, what we got with this presentation. So, and we understood the bond validation and the time value of money is very crucial for investors to make informed decisions and optimize the returns in the bond market. And I always encourage others to, I mean, investors to apply the concepts that we learned today to analyze the bond investments effectively, mitigate risk, and capitalize on opportunities in the fixed income market. These are the references which I used to make my presentation and the PowerPoint. And that's it. Thank you.